Okay, what is up, tycoons? What is up, traders? Super excited for today's video. Going to give you guys another market update. We're going to take a look at TLT, the stock market, bond market, commodities, a bunch of different other things, as well as an exclusive set of data that I really think I'm one of the only YouTubers out there providing, going over some very, very crucial data. So make sure you smash the like button, subscribe to the channel. I think I've finally found a core set of data that I'm going to start going over in each of these videos. After I've been making these TLT videos now for about a month or two, I think I've nailed it on the stuff that I really want to highlight and what really affects the price of TLT and the stock market, so that you guys are properly prepared and truly understand things that are going on. Now, we have some big news that just came out. The US December consumer prices were revised higher, guys. They actually rose in December instead of falling as previously estimated. Revised government data showed on Friday the consumer price index edged up 0.1% in December rather than dipping 0.1% as reported last month. The Labor Department's annual benchmark revisions of CPI data showed. Data for November was also revised higher to show the CPI increasing 0.2% instead of 0.1% as previously estimated. Excluding the volatile food and energy components, the CPI rose 0.4% in December instead of 0.3% as previously reported. Data for November was revised up to show the so-called core CPI advancing 0.3% instead of 0.2% as initially estimated. Guys, we have had one of the most bullish Januaries we have ever had in the stock market in a very long time. And a lot of it has been fueled off of the past two CPI and inflation reports, okay? You know, you get the November data in December. You get the December data in January, and the market has been going completely bullish and, really pricing in Fed rate cuts, even though he hasn't said he's going to, do these rate cuts because of the CPI data that's been coming out. And look what happened, guys. Was this all just another massive bear market rally to really trap people in, gain liquidity, and ultimately push prices lower? Really, really interesting. Now, if you've been watching my videos, I've been posting this chart now in the last few videos that I've made, and it is one of my favorite charts that's been really, really useful in the past year, okay? We have the S&P 500 futures here in red, and we have TLT in blue. TLT has continued to be a leading indicator for over the past year. Look at this. When the stock market is making higher highs, but TLT is making lower highs, the stock market ends up following. TLT has been a leading indicator. Same thing happens over here, higher highs, lower highs. What happens? Stock market makes a new low. Each time this happens, the stock market makes a new low, guys. It's crazy. Over here, even to the bullish side, TLT is making higher lows here. Stock market's making lower lows here. And what happens? It's a leading indicator and the stock market follows. Okay, then over here, stock markets start making higher highs again. TLT is making lower highs. Boom, we see a new low. Over here, I've been pointing this out, guys. We're making higher highs. Yes, the stock market has been bullish, but TLT has been making lower highs. If this pattern that has played out for the past year is going to play out again, the stock market potentially could make new lows. All right. Now, this is another chart that I've made, all right? And I'm making all of these charts myself, guys. I mean, there's no other YouTube out there really I see putting out this type of information. So make sure to really, share these videos so other people can get some really good data and information that, isn't just readily available out there. That's actually highly accurate, okay? So what we have here is going to be the stock market. We have SPX, okay, the S&P 500, versus the WYCKOFF, okay? And this is the WYCKOFF method. Now, if you're not very familiar with it, it's something that a lot of traders use, okay? And a lot of hedge funds and institutionalists, they all like to look at something like this and use the WYCKOFF and take this into account. Look at how almost perfectly we're matching up directly to the WYCKOFF method when it comes to the S&P 500. We have spring over here. We have the spring. Okay, then we get our distribution phase. We have the distribution phase right here too. We get the breakdown, throwback, right? We come up and we come up above the breakdown level. That's our throwback. That's what we did, okay? And then you have your correction phase right underneath that, and that's what we did. And I pointed out we could be at the top of correction. And if this is true, guys, and if we're going to follow the Wyckoff method, then we could be in for a big move to the downside into redistribution, which would put the S&P 500 anywhere from 3,000 to 3,500. And you know, a lot of people aren't ready for that. Now, I'm not some perma bull or some perma bear and really just, you know, trying to say that everything's going to collapse, but you can't ignore some of this data, guys. You really can't. Okay, so very, very important charts that we're showing here. Now, the next one is something also that you really need to pay attention to if you're not. Okay, this is going to be the US dollar 10-year treasury yield, stocks and bonds. Okay, and if you want to be trading the stock market or the bond market, whether it's individual equities or the markets as a whole, okay, you need to be paying attention to Dixie and TNX. All right, Dixie is going to be the US dollar, TNX is going to be the 10-year treasury yield. And this is the beginning of February, guys. So since the beginning of February, the 10-year treasury yield and the US dollar are positive. Dixie is up 2.38% and TNX is up 10%. Meanwhile, the stock market is down 0.7% and the bond market is down 3%. So, you know, you have to understand the relationship between, you know, the US dollar, the 10-year treasury yield, and stocks and bonds. Okay. If TNX and Dixie are going up, typically you're going to see the stock market and the bond market going down. That's just how things work. Now, this next chart that we have, okay, is PMI versus core sticky inflation, guys. Core sticky inflation is above 30-year highs, guys. And PMI, meanwhile, has been puking, absolutely collapsing. Okay, now that's giving off the impression, just like a lot of that old CPI data before it was revised and actually bad and not good, it's giving off the impression that, hey, you know, the Fed is actually going to have to cut rates at the end of this year because PMI is coming down, inflation coming, all these different inflation data are coming down. But look at sticky inflation, guys, and you know, this really shows this was kind of like a tale that almost proved that, you know, these numbers were almost going to come back revised higher because core sticky has just gone up. It's gone up, and inflation is going to be much stickier than a lot of people are prepared for. Okay, and I went over this chart in a couple videos as well, really just highlighting how, you know, sticky inflation is just going to be stickier, right? This is core sticky inflation. So, you know, this is that stuff minus food and energy. All right, which, you know, in that original article from Reuters that we posted, you know, they were talking about that as well. Now, this next one is core sticky inflation versus the Fed funds rate. So we have core sticky here in white this time and the Fed funds rate in red. Look, the Fed's fund rate needs to be above core sticky inflation for core sticky inflation to go down. That's how it works, guys. Okay, look, red over here goes above core sticky inflation. That's when you see it start to go down, guys. It comes up above core sticky inflation. That's when you see core sticky inflation start to go down. We're not there right now, guys. We are not there at all. Inflation has just skyrocketed along with the Fed funds rate. It's gone up at its most aggressive pace pretty much ever, historic pace that we're really raising rates. But at the same time, inflation is just much, much stickier than a lot of people are pricing in and a lot of people are ready for. Now over here, we have TLT versus the Fed's fund rate. So that way you guys kind of understand how TLT is correlated to the Fed's fund rate. So this is when there was free money over here, okay? And basically interest rates were almost zero or practically zero, and it's just free money, right? So what you're seeing is you're seeing the bond market go up. You're seeing the prices of bonds go up as bond yields are going down, and this is good for the bond market. This is good for TLT when you have this free money, these super low interest rates. And then what happens as soon as the Fed funds rate starts to creep up, look what happens to TLT. It goes down, okay? And then right here we see TLTs going up, and not coincidentally, the Fed funds rate is going down. Then we have this period of free money here, and look what happens, guys. Fed funds rate has skyrocketed and TLT is collapsing. So it's not a coincidence how some of these things are correlated. And, you know, over here, I highlighted how essentially the bond market was trying to call the Fed's bluff, and that perhaps they were calling the bluff too early when we saw this aggressive spike in TLT. And we haven't even seen the Fed funds rate start to drop yet, right? It's actually still going to go higher, and they're just pricing in rate cuts a little bit too early, essentially saying that the Fed is going to bluff, right? A lot of people are anticipating rate cuts, and so they want to get in early so that way they don't miss out on the gains, because a lot of other people are going to be buying in and could rise the price up higher. Risky stuff to do. Now, here's the Fed funds rate versus financial conditions, guys. So the Fed fund rate is here in red, and then we have financial conditions as well as the adjusted national financial conditions, okay, in blue and orange. What I want to highlight, and this is something that I've actually been highlighting a lot in my charts too, but financial conditions are now looser than the first rate hike, guys. This is the first rate hike right here. Look at financial conditions. This is where financial conditions were at the first rate hike, guys. We are lower. Jerome Powell just straight up lied in his last press conference and said financial conditions have gotten tighter and they've been improving and heading the direction that we want, when the guy has raised interest rates, the Fed fund rate, by 300 basis points. Not even 300 basis points, but he's raised it more than that. He's raised it so much, guys, and financial conditions are looser. Okay, so really, really weird. It was baffling to me whenever I was watching that press conference and he said that. I was blown away. I said, what data is this guy looking at, man? But you know, I took the trades. I took some very bullish trades at that time whenever I started hearing him speak dovish like this, and it worked out good and it worked out in my favor. So, you know, my own opinions aside, you know, you have to trade what the market is doing and react to it, but be prepared, you know, for some of these fake outs. Okay. Now, the next one we have is the stock market versus financial conditions. Okay. And so we have SPX here in this tealish color. And again, we have financial conditions and adjusted national financial conditions here in blue and orange. Now, this was his famous Jackson Hole speech right here. Okay. And you can see that the stock market collapsed afterwards and financial conditions actually rose. So, you know, at the point of his Jackson Hole speech, he did what he wanted, right? The Fed's whole job around this time, and one of his main focuses was we need to tighten financial conditions. All right. But since then, we've increased the rates 300 basis points from his Jackson Hole speech. And again, financial conditions have puked, guys. If you look, this is the level that they were at, this white line, at the Jackson Hole speech, and we're much lower. Financial conditions have loosened much, much lower, and the stock market is breaking out as a result, right? And it's just really interesting to me that he is out here saying that financial conditions are tightening. That was just mind-blowing. Now, the next chart we're going to go over is the relationship between the bond market, the stock market, and the commodity market, as well as inflation. So in periods of deflation, what you're going to see is you're going to see the bond market as well as stock market start to go up, okay? And you're going to be seeing the commodity market going down. And when inflation starts to pick back up, you're going to start seeing the stock market go down, the bond market go down, and that's when you're going to see the commodity market go up. Now, if that chart's not the best visual, I understand. This is just the business cycle rotating through asset classes. I've got another one right here explaining it a little bit clearer, and these are the different phases, right? So in phase one, you're going to have bonds bottom first, okay? Bonds are here in green, stocks are in blue, commodities in red. So phase one is bonds bottoming first. Phase two is going to be stocks bottoming, and then phase three is going to be commodities bottoming, guys. Then in phase four, you see bonds hit their peak. Phase five, stocks hit their peak. And then phase six, commodities hit their peak. And at this time, when commodities are peaking, shortly afterwards, you're going to see bonds start to bottom out and repeat the phases all over again. So what I've done is I've actually created this chart for you guys, all right? And we have stocks versus bonds and commodities, okay? So we have bonds here in red, we have stock market here in blue, and then we have commodity market here in white. So good old red, white, and blue, go USA. We are in phase five right now, guys, or we were in phase five, okay? And that's when you see the commodity market start to creep up above the stock market, okay? So let's look at phase five right here. At the end of phase five, you see commodities in red go above the stock market, and the stock market cross below the commodity market, okay? And so that's what we got here. Remember, stock market's in blue, we see it cross down below, and we see the commodity market here in white cross out above. And it looks like the commodity market has topped out, guys. And so what happens in there is phase six, okay? Phase six shortly happens afterwards, where the commodity market tops out. You're still seeing stocks plunging. You're still seeing bonds plunging. But the cycle is going to restart with phase one, with the bond market bottoming. So we need to see the bond market bottom first. All right. So there's no, really way to say when this phase 6 is going to be over. Eventually, once we see the bond market bottom, there's always the potential that we could have bottomed already. But it's just been really interesting that, stocks have been outperforming the bond market when that's not the way that the phases work, right? The stocks are going to underperform and bonds are going to start to outperform. And then the stock market will bottom in phase 2, and in phase 3, stocks will really catch up to the bond market. So remember, we're in phase 6 right now, and that's going to lead to phase 1, right? Which is going to end up leading to the next bull market for the stock market and the bond market. But you just have to be patient. Okay. Now, what we have here is going to be the open interest data. So, I started showing open interest data and some open interest stuff in my last video. A lot of people commented that, they liked it. They want me to include that stuff. So I have a quick summary, and then I actually have some bar charts just really visualizing the open interest for you guys. Okay. So when it comes to TLT open interest, the option open interest climbed 1.8% to 2.1 million contracts. The current open interest is below its 52-week average of 2.2 million contracts. Currently, the OI percentile rank is 39.8%. So TLT had a higher open interest 60.2% of the days in the last year. The most notable increase was in the February 24th, 2023 expiration, which added 31,597 contracts. Now, TLT call open interest increased by 1.7% to 1.3 million call contracts. Furthermore, call open interest is up 2.3% in the last 5 days compared to its 52-week average of 1.4 million contracts. The current call open interest for TLT is weaker than usual. TLT put open interest. The open interest in put options has grown by 1.9% to 761,189 contracts. However, put open interest has fallen 4% in the last 5 days compared to its 52-week average of 797,000 contracts. The current put open interest for TLT is lower than usual. We have the TLT put to call ratio. And in the last 5 days, the put to call ratio for TLT decreased by 6.2% to 0.6. Now, we have some of the most active options right here. All right. And when it comes to the call open interest trends, the March 17th, 2023, 111 strike price went up by about 360 and when it comes to open interest in the past 5 days, which is one trading week. All right. And when it comes to put open interest, the 102 strike for February 17th, 2023 went up by 1,238. So you're almost seeing a 4x when it comes to the 5-day change in the highest, option activity strike. And also, it is a closer expiration than the March 17th. So, short term, things went a little bit bearish right here. Now, when you look at the call open interest churn, what we're basically looking at here is the open interest change as a percentage of the options trading volume. The conversion rate right here for calls was down 40%. Meanwhile, the conversion rate here for puts was up 29%, guys. So, just kind of backing up some of that, short-term bearish data at least. Now, over here, we're taking out the open interest for March 17th, okay? And we have calls, obviously, in green, and we have puts, obviously, in red. Now, take a look. What's super interesting, guys. The call open interest total is higher. Okay, it's at 342,000. Meanwhile, the put open interest is at 326,000. But look at where the highest strike price is right here. It's at 95, and we see there's an unusually high open interest, okay, on both calls and puts. So calls actually top it out at over 150K. But, you have to realize these are in the money. So this is kind of creating a wall almost. All right. And, basically bulls are trying to hold it up at this level above 95. Okay. This is the current level that we're at on TLT, this dotted line right here. All right. Now, what's interesting is that the put open interest on this strike is super, super high as well. So, being that there's so much open interest right here at this 95 strike, we may start to gravitate towards this throughout March and really get closer back towards this 95 level. Because there's so many puts here, and these are all out of the money, extremely out of the money, versus the call options that are already in the money. And we really may gravitate back towards that level. Now, when you look, everything else is pretty much bullish, right? It's mostly call options over here, with higher strike prices. And then we have the 75 strike with a really high open interest as well. But that's pretty far from where we're at. TLT would have to drop like 25%, within the next 34 days for that to happen, which would be, mostly unlikely. Now over here, we have the May 19th, okay? And we're seeing something very similar, right? But what I want to highlight is, again, this 100 strike price, right? And these are the in the money call options, okay? But when it comes to the put options, there's such a high open interest on these that we may gravitate back lower towards these prices just because of the fact that they're out the money. And, there's such a big bet on those, that we may just gravitate back towards some of these prices, and some of these strikes with the really higher open interest as we get closer to these expiration strikes. But one thing I do want to note is that as we start to go further out in option expiration date, right now we're in May, and these are 97 days away from expiring. Look at the difference in the call open interest towards the put open interest, right? We're seeing that it's much, much greater, and that there's about 33,000 puts versus 81,000 calls. And we're seeing a large concentration in call options and out of the money around 115 and also 105. So it's going to be really interesting. The 100 calls are already in the money. Are we by May, are these this isn't 105, I'm sorry, this is 107. Are we going to be closer to 107? Are these 107s going to be in the money? Are we going to be closer to 115? Or are we going to be closer to this 100 strike price right here? Now over here we have the January 2024 expiration date, and calls just completely outweighing the puts, guys. 130,000 calls, and with about 37,000 in puts. Now I do personally think that TLT and the bond market is super attractive right now. Okay, we haven't really seen bonds look this attractive in a really long time. Okay, so that doesn't mean that there's not more pain ahead. Whether that pain is going to be short term, whether it's going to be for a couple months, or whether it's going to be for another year or so, definitely do some of your own research and take a look at some of the historic levels of bonds and see if they're attractive right now. I know bonds normally aren't a hot topic, but they do offer good opportunities, right? And you can trade them. You don't have to go in there and buy necessarily just bonds, buy a 10-year treasury and hold it to maturity. You can trade ETFs like TLT, or you can actually trade the bonds themselves. And eventually the Fed fund rate will go back down. It's just a question of when, right? And so the market's pretty bullish, and been pricing in Fed fund rate cuts by the end of this year. Perhaps they're right, and perhaps that happens, or perhaps inflation sticks around for a little bit longer than people are expecting, and we're in for a little bit more pain before we see the bottom and we finally get that move. But when it comes to long term, looking years in the future, the bond market definitely looks attractive right now. And it's not just me saying that. There's hedge funds saying that, there's financial advisors saying that, and it's a lot of talk about the bond market right now. People are actually really, really excited at the opportunities in bonds. Now I'm going to end the video off saying, of course, none of this video is financial advice. My opinions are my opinions. I try to keep my opinions out of this, and just go over some very important data for you guys, and hopefully you enjoyed it, right? And if you did, smash the like button, subscribe to the channel, and share the video, okay, so other people can find some of this data. I think it's pretty useful, and they may think it's useful as well.